All right, let's dive into something that honestly powers our entire global economy: currency exchange rates. Now, you probably think about this stuff when you're planning a vacation, right? But it is so much bigger than that. We're talking about the biggest, fastest, and maybe most important market you've never really seen. So let's pull back that curtain and figure out what really makes the world's money go round.
Okay, first off, I want you to try and wrap your head around this number. $10 trillion. That's what market analysts are predicting for the daily turnover in the foreign exchange market, the FX market. And I want to be super clear here. That's not for a year or even a month. That's every single day.
And to put that into perspective for you, that 10 trillion a day, it makes the FX market about 50 times larger than all the world's stock markets combined. I mean, it just absolutely dwarfs everything else. It's not even in the same league.
So yeah, our first section is all about this, the world's biggest market. Seriously, this is the place where money never sleeps.
So the big question is, who's moving all this cash around? Now sure, tourists swapping their dollars for euros are technically part of it, but they're like a tiny drop in the ocean. The real action, the vast majority of all these transactions, is driven by two massive forces. You've got international trade between companies, and you've got these huge cross-border capital investments. And you might think, oh, okay, so this is all about companies like Apple buying parts or Toyota selling cars, right? Well, nope. That's actually just that little 13% slice you see there. The real heavyweights, the ones moving the big money, are financial clients. We're talking investment funds, pension funds, and of course the banks themselves, who are trading currencies just like their stocks or any other asset.
Okay, so we know it's huge, but how does this whole enormous market actually work? Let's break it down and get to the basics of what a currency's price really means.
At its heart, an exchange rate is just a price. It's that simple. So if you see a quote like Euro/USD 1.10, here's what it means. The first one, the euro, is what we call the base currency. That's what you're buying. The number, 1.10, tells you how much of the second, price currency, the US dollar in this case, you need to buy one of the base. So bottom line, it costs you $1.10 to buy one single euro.
Now, that price you see on the news or at the airport booth, that's called the nominal exchange rate. It's the official, straightforward number. Seems simple enough, right? But, and this is a big but, that number does not tell the whole story.
Because the really important question is this: what can that €1 you just bought for $1.10 actually buy you once you get to Europe? I mean, think about it. Is a cup of coffee in Paris the same price as a coffee in New York? Probably not. And that brings us to something called the real exchange rate. This is a much smarter number. What it does is it takes that nominal rate we just talked about and it adjusts it for the different price levels between the two countries. It's the number that tells you a currency's true purchasing power. Probably the most famous example of this, and it's a great one, is The Economist's Big Mac Index. Yeah, seriously. By comparing the price of the exact same hamburger all over the world, it gives you a really fun and actually surprisingly insightful look at whether currencies are over or undervalued in real terms. It makes this abstract idea of purchasing power super easy to digest.
Okay, so we know these rates are changing all the time, which, as you can imagine, creates a huge amount of risk for anyone doing business across borders. So how on earth do they manage all that uncertainty? Well, that brings us to our next section. Trading for tomorrow. We're talking about hedging against an uncertain future.
Basically, there are two main ways to trade currency. First, you have what's called a spot transaction. That's for right now. Or, well, in market speak, it means the deal settles in 2 business days. But the really powerful tool is something called a forward contract. This lets you lock in an exchange rate today for a deal that's going to happen weeks or even months down the road.
Let's use an example. Imagine you're a US company and you're buying supplies from Japan. You agree on a price in Japanese yen today, but you don't actually have to pay up for 90 days. Think about that. In those 3 months, the exchange rate between the dollar and the yen could swing wildly. It could completely change your final cost in dollars. That level of uncertainty is a massive risk for a business.
And the solution to that problem? The forward contract. The company just goes to a bank and they agree today on the exact rate they will use to swap their dollars for yen in 90 days. Just like that, the risk is gone. Poof. It's basically a form of financial insurance against a super volatile market. And what's really fascinating is that spot transactions, the trades for now, they only make up about 1/3 of the entire market. The vast majority of the action comes from forwards and other things like swaps. These are all tools designed to manage future risk.
So hedging isn't some niche little corner of the market, it is the main event.
All right, for our last section, let's zoom way out. If these exchange rates are so critical, do countries just let them run wild? Well, not exactly. Every country has to choose a strategy, or what we call a regime, for how it's going to manage its money. The best way to think about this is like a spectrum. On one extreme, you've got fixed regimes. This is where a country literally pegs its currency's value to another one, like the US dollar. The goal there is stability. Then, on the complete other end, you have floating regimes. This is where you just let the market, supply and demand, decide the price. The goal there is flexibility.
And you can see this whole spectrum in action all over the world. You've got Panama, which is dollarized. I mean, they just use the US dollar as their own currency. That's a super hard fix. Then you have Hong Kong, which uses a currency board to keep its dollar tightly pegged to the US dollar. China's in the middle, with a crawling peg where they kind of manage their rate against a whole basket of currencies. And then you've got countries like the US and Canada who just let their currencies float freely based on the market.
So, you're probably asking, why doesn't everyone just pick the best one? Well, because there's this huge fundamental trade-off. It's a classic dilemma. If you fix your exchange rate, you get stability, which is awesome for trade and business. But you lose control over your own domestic monetary policy, like setting interest rates. On the flip side, if you let your currency float, you get control over your monetary policy, but now you have to live with all that exchange rate volatility. There really is no perfect system.
Okay, so let's wrap this up with the key takeaways. What did we learn? First, the FX market is just unimaginably huge, dwarfing everything else. Second, a currency's quoted price, the nominal rate, is totally different from its real buying power. Third, businesses aren't just gambling. They use smart tools like forward contracts to manage future risk. And finally, every single country is stuck with a massive trade-off between stability for their currency and control over their own economy.
And that really leaves us with one last big thought to chew on. As our world gets more and more interconnected, with trade, money, and information just flying across borders faster than ever, are countries going to be pushed toward more unified, similar currency rules just to keep things from getting chaotic? Or will those exact same forces actually create more volatility and make everyone's policies drift further apart? Honestly, that's the multi-trillion-dollar question for the future of the entire global economy.